Okay, good evening, everyone. Hello, and thank you for joining us at the TD Propelling Black Entrepreneurship webinar series. My name is Bernice. I am the Marketing and Communications Manager here at the FACE Coalition. We are a nonprofit organization funded by the Government of Canada and the Business Development of Canada and supported by like-minded institutions like TD Bank to provide resources to Black entrepreneurs nationwide. In particular, we do offer loans up to 250,000 Canadian dollars, and we are very excited to have you there for this particular webinar series. So this series was created to equip Black entrepreneurs with knowledge about business plans, tax filing, and financial projections that are not only important documents for business owners, but are also the services that will be provided to successful applicants to the TD Propelling Black Entrepreneurship Program when we begin our call for applicants in September. I'm very happy to have with me Tamara, who is the project coordinator for this program, who will be providing additional details toward the end of this presentation and will also introduce today's featured presenters from MNP who have been so gracious to share their expertise with us today. I'd also like to welcome or introduce Badra, rather, who is our Face Coalition. She's the marketing and communication support officer here, and she is going to be assisting on the back end. So thank you all for joining us today. And Tamara, I'd like to hand over the floor to you.
Thank you, Bernice, for the introduction. Welcome, everyone. Good evening. Now I have the distinct pleasure of introducing our workshop facilitators. Today, our workshop will be led by Cylena, and she'll be assisted by Steve. Cylena is a senior manager with MNP's Private Enterprise Services team in Markham. She provides full-service, tailored advisory, tax planning, and compliance solutions to help privately owned businesses succeed. Her expertise includes financial reporting and compilation engagements, as well as corporate, personal, and trust income tax planning and compliance. She also advises clients on a wide range of business matters and connects them with MNP's extensive network of specialists when needed. Cylena holds a Bachelor's of Accounting from Brock University, 2008, and is a chartered professional accountant, having earned her Certified General Accountant designation in 2014. Steve, CPA auditor, is a partner with M&P's Assurance Services Groups based in Montreal. Focused on developing a relationship of trust with his clients, Steve provides audit, corporate, and personal tax services. With more than 15 years of experience, Steve has worked on mandates for companies in various industries, including hospitality, retail, automobile, manufacturing, technology, renewable energy, and financial services. He has also worked with several not-for-profit organizations in the medical and educational sectors. Providing high-quality service at all times is a priority for Steve. As a partner, he is proud to be able to find solutions to his clients' requests or to guide them towards the expertise and assistance that best suits their needs. Steve is a chartered professional accountant and chartered accountant qualifying in 2011. He has a graduate diploma in public accountancy from the École des Hautes Études Commerciales of Montréal. Thank you. And now I'll turn it over to Cylena.
Good evening, everyone. And before we start, I just like to thank you guys for taking the time to be here with us. We really appreciate it. Now let's get into the nitty-gritty of tax filing for your business. I promise you it's worth the wait. So good evening. Sorry about the hiccups earlier. I just want to let you know that we're gonna help you, assist you, and demystify tax filing for your business. It's important as a business owner to understand your tax obligations, when they're due, and how often you have to file. So we'll go straight into the filing requirements. Generally, I'm going to speak from because most of you either have a corporate or most of you have corporations. Corporations are required to file tax return on an annual basis. Any tax balances are due 2 to 3 months after the year end, depending on your tax situation. And the tax return, the final tax return for that respective year is due 6 months after the year end. So I'll give you an example. So let's say you have a company and it has a December year end. If it has a December year end, then you're required to pay taxes on that income earned either February or March of 2026 if your year end is December 2025. So what we typically do is we'll collect the information from the client and then we will do a tax estimate. And based on that tax estimate, we advise, okay, you need to make a payment, and we'll tell you if it's either February installment deadline or a March. And then the final return is not due until June 30th, 2026. So I wanted to give you a live example. So generally, if your net tax is more than $3,000 on that December 2025 filing, you're required to make installments, and those installments can be quarterly or annually. Again, that's something we'd help you based on your specific scenario. But this is just, like I said, to demystify what the timeline is and what is required.
Can I add something quick? So, as Cylena put it, there's a timing difference here, right? If you run a corporation that is profitable, you have to put in your calendar 2 to 3 months. You have to do payment, right? If the payment are not done on time, there is penalty, and Canadian Revenue Agency and Revenu Quebec and all the province increase the rate of interest. It's like up to 9 to 10%. So it's really, when you do your cash management, it's really important to have those deadlines in mind. Make sure to do the payment. Usually what we do for our clients, we told them, look, how much profit you're gonna make sure to pay your balance of tax. Pay your balance of tax. You don't want to pay the government for no services, right? Penalty, it's like money throwing out of the window. So it's just, I just wanted to add that to the comment.
So then the next part is, if you have taxable supplies of over $30,000, let's simplify it. If you have sales of over $30,000, you're required to register for HST. And there's either a monthly, quarterly, or annual filing period. And that's determined by the amount of sales you had in the previous period. So if you're an annual filer, here again, you'd be required to make remittances on a quarterly basis. And the same rules apply if your net tax is over $3,000, then you're required to make those in payment. You're required to make those installments. To give you another example, let's assume that your fiscal year or your corporate year end is the same as your GST year end. Then if you have a December 2025 year end for HST purposes and you're an annual filer, your first payment would be due April, followed by July, October, and then January of the following year, just to give you an idea of how the money is going to be reported to the government and in what period it covers. Now there might be payroll. Maybe you're on payroll. Maybe you have your employees on payroll. Generally, it's not in I say generally because there's exception to every rule. For everything I say generally because there's different rules. So generally, payroll is due the 15th of the following month. So let's say we're in August 2025, you paid your employees twice. So you paid them August 1st and you paid them August 15th. The payroll remittance is required for that entire August payroll is due September 15th. Again, there are exceptions. Another Another, this is also related to payroll, it's the T4s and the T5s. So you have to report all the income you paid to the employee on a calendar year. So that is due. So if it's January to December 2025, because we were always on a calendar basis for this reporting, that payroll, that T4 would be due at the end of February. And there are penalties for everything that's late. So let's get through the common mistakes to avoid. Poor record keeping. I always give an example. You could end up paying more tax unnecessarily by poor record keeping. An example that I would give is we need documentation for the expenses that you're going to provide for us. And we'll ask you to annotate on the bank statement, visa statement, what's the expense. Because there's a difference in the tax treatment of meals and entertainment, where you take your customer out, versus you're having a Christmas lunch for all your employees. There's different rates. So it's important. You need to keep records so that we could figure out how to properly classify your expenses and get you the maximum deduction. Another one we see is deferred revenue. So your customer gives you, say you have a December year end, your customer gives you a deposit for future services that are not going to happen until January of the following year. That is not income until you've performed the service. So a lot of people will put it as income when it really isn't. So what you've done is you've prepaid your tax. And you want to avoid that because you can use that money for other things to grow your business. You want to keep yourself liquid. So these are some of the common mistakes. That's why it's important to reach out to your tax professional, because we're dedicated hours and hours and years to understanding the tax rules and understanding their impact on you. So that's what I would say. These are the common mistakes we see, especially when we onboard new clients that haven't worked with an accountant before. So I wanted to show you the steps to financial statements and tax returns. So FACE is going to provide a readiness checklist. It's something that we use to onboard new clients. It basically tells the clients what we need from them to prepare the year end and tax return. So that's the start of the process. So once you have everything ready, we'll review the information, and then we provide a follow-up on any missing information. So if we notice that, oh, you forgot to send us the bank statements or the visa statements, we'll follow up. But we have a list of exactly what you need. So it's really good because you could just tick it off and say, okay, done, done, done. And then once we review the information and you've sent us everything we've requested, we'll start our work on the bookkeeping. We'll follow up again on any missing or unclear information. Once we complete the bookkeeping, we'll start the financial statements and tax return preparation. After we've completed that, we'll present the financial statements for discussion and eventual approval. Part of the discussion process is to identify any opportunities for tax savings. We'll review your ratios with you. Similar, if you were in our course last week, we talked about ratios. We bring it up, like if a ratio seems off, we'll say, hey, this is off. Maybe you should really watch this because you're going to end up in liquidity problems. And then just to let you know, we'll review the opportunities, but it could be outside the scope of the engagement. And we'll let you know, and we'll provide you a code for those additional services. So we'll go through the most common forms of business ownership. I'll go through them fairly quickly. I know Steve has, he'll say a few words on the not-for-profit organizations, but we're mainly focusing on corporations. So sole proprietorship, most people know about this. You might not know the correct terminology, or I don't even call it the correct terminology, it's just the way we say it. But basically, this is when you report all this income on your personal tax return. There is no corporation. You and the business are intertwined. It's easy because it's something you're doing. There's no extra reporting. The only thing I would tell you, one of the things we see is that you always hear a lot of advertisements saying, hey, if you're self-employed, then your tax return is due June 15th. Yes, your tax return is due June 15th, but your payment is due April 30th. So you're still supposed to estimate the payable at April 30th, and then you can file your tax return at June 15th. So that's one that people don't understand. So that's one of the things that, yeah, so it simplifies your filing because it's one filing. It's just your personal filing. There's no corporate. The other thing too is that you're going to be taxed at a higher rate. I'll go through the tax side later, but for example, if you made about $400,000, you'd be taxed as a sole proprietor at a tax rate of 53.5% in Ontario. So the rate is very high. As you'll see, if you had a corporation, that if you have an active business, that tax rate is as low as 12.2% in Ontario. So there's significant deferral of tax if you have it in a corporation. So sometimes it can be difficult. Some of the disadvantages could also be it's hard to raise capital, and there's unlimited personal liability.
Or do the non-for-profit. I don't know, the breakdown of the audience today, but for non-for-profit, you have to, be careful on the status that you have. If you have a charity status, there's a bunch of requirements you have to do to maintain the status, right? I put on the slide disbursement quota. So basically, the disbursement quota is a limit. It's a threshold of charitable activity expense that a non-for-profit has to do on a year-to-year basis to maintain the charity status. It's important to respect it. There's a charity return that comes along with those requirements. So basically, your accountant, if you hire MNP, we should tell you exactly how much you have to do in terms of charitable activity for the next years. If you don't do it, you risk to lose your charity status. Sometimes there's like heavy penalty. I'll give you a small example. A client of mine, large non-for-profit in the Quebec region, it didn't do it. On top of almost losing for 1 year, they wanted them to pay like some sort of heavy penalties. We fight, and they reduced the penalty from like 1 million to be 100, 150. So it's large amount, but it's because there was large amount involved in that specific non-for-profit. So we want to raise that information. So make you guys aware of those requirements. Yes, you're exempt from tax, but if you collect money from the public, you might have to do an audit if your revenue reach a certain threshold. I think it's 250K. If your revenue reach 250K, all type of sources, you have to do, it's mandatory, you have to do an audit, which is like a heavy process. There's a whole slide, I think, or last week video is already on Face channel, so you can go check the whole video regarding the whole masterclass regarding financial statement. And we talked about audit and the type of certification or assurance we can have on financial statement. So that's high level regarding NPO. So pass the baton to Cylena.
Thank you, Steve. So we'll talk briefly about partnership. We don't expect it, but it could be an option, but we can talk about that offline as necessary. Basically, you share the risk, you share in management. Those are the biggest advantages. And the disadvantages are you have shared decision-making. Maybe you have different ideas and it could lead to conflicts. But either partner can be responsible for business debt incurred by the other partner. So you really have to trust the person you're going into a partnership with.
And I'll add something quickly for
Oh, yeah, go
partnership.
ahead.
I do a lot of, venture cap, hedge funds, and when people want to raise money, usually those funds, they form a partnership because they want to take money from multiple partner and share the risk. MNP is the partnership. There's a bunch of partner all across Canada. We share the risk, we grow the business, we put money in. I see a lot of partnership as well in the real estate industry, where you have the main general partner doing the project, but you have a bunch of limited partner that put money in the real estate project. So, and at the end of the day, partnership, it's not like we're gonna see the corporation next, which is the most used type of the incorporation, which is the most used type of company in Canada. But the partnership, you see that a lot in real estate. Why? Because at the end of the day, you share every profit is like it's a flow through, right? You made a profit in the partnership, it got distributed directly to the different limited partner. It's not the same thing for Inc. or a corporation per se. So Cylena gonna go through that in the next slide.
So corporation, this is where we'll spend a lot of our time for the rest of the presentation. There's limited liabilities. Owners are not responsible for the company's debts or obligations. There's a legal separation between the shareholder and the corporation. I mentioned previously when we talked about being self-employed, there was no separation. You are one with the business. You have access to a different set of tax credits. Sometimes it's easier for financing. Also, I had mentioned previously the corporate tax rate. The lowest tax rate in Ontario is 12.2% on active business versus if it's below 500,000 and below, if you had earned that money personally, you'd be looking at a tax rate of 53.5. There's also one under asset protection, which is really good in terms of passing wealth down to the next generation, safeguarding what you built with your blood, sweat, and tears. One of the disadvantages is it's more expensive form of business to set up. There's a legal cost to set up, and also recurring legals. And there's also recurring accounting fees. But it wouldn't be as much as if you were self-employed, but you also have more opportunity in a corporation. I'll talk about it later about the income split. Like there's a lot of benefits to corporation, and then an asset protection is a big one. Those are the biggest ones that we can think of, that I can think of.
I think that's the most interesting part of the presentation, actually, because you said 12% of the max you can get is 26% on the corporation side, and on the other side, on the personal side of self-employed, you can go up to 50%. So there's a major gap here, and there's like tools and there is tax advice that we can put in place or give you guys to take advantage of those type of structures.
So typically when you start a business, this would be the structure we would see. There'd be a shareholder and then there'd be an operating company. So I believe most of you would fit into this category. Sometimes you can add a spouse, and we'll talk about the implications later of adding a spouse, especially if they're not active in the business. We would prefer if they were active in the business. Not prefer, we need them to be active in the business. It's not a preference, it's part of the rules.
And in this type of structures, basically, let's say you were to own all the money, let's say for the example, we take 500K. You made 500K, self-employed, you would have paid, I don't know, 200 per, rough calculation, right? In the corporation, it's going to be a lot less, right? It can be 60K, 65K, right? If you're not putting the money out of the company, that's important, right? I think we're gonna address that.
Yeah.
Food for thought. We're gonna address that in the next slide.
Okay. So we kind of give you guys a heads up that we're going to talk about this. So if you look at the federal rate, it's 9%. Then we look down at Ontario and even Quebec, it's similar to rate. In 2025, you can see that it's 9 plus 3.2, and that's where we get our 12.2. That's amazing. Even better if you're in Saskatchewan and Manitoba. If you want to brave the cold for lower tax rates. um, so now there's the rate before, the slide before is if your income's below 500,000. If it's above 500,000, then you're looking at a rate of 26.5% in Ontario and similar in Quebec as well.
Yeah.
Again, that's a big deferral. So if you make $1 million, the first 500,000 is at 12.2, the next 5 is at 26 and a half. While if you had earned all this money personally, you'd be subject to 53%, 53.5. So it's really, it's astonishing.
Look, but you have to use it properly, right? That's why you need,
the thing.
tax advisor like us to make sure that you use those structures properly. It's not, you want to pay your fair part, but if there is, tax advice you don't need, let's say you make $1 million, you don't need $1 million to live, you need just 100K. Why don't you leave 900 in the corporation, pay 12%, and reinvest the money after tax in your corporation? I think that's the end game here. When you are in the growth stage, you just want to reinvest as much as you can in your corporation. And tax, the rule out there, the rate are public. You use the right rate, the right structure, and then you can save a bunch.
Yeah, and as you grow your business and you decide, okay, I have all this extra cash, you can invest it in the market. We can help restructure so that the investments are in a separate company and that it's protected from debtors. That's what we're talking about, asset protection. So, and that can form part of your retirement. So when it's also a plan of when you want to sell your business. There's some tax planning strategies when you want to sell your business. So that's the fun part of tax. I don't know. Steve and I are geeking out. We're trying to hold it back.
Exactly. So we'll move to the tax credit.
So these are some of the tax credits that's available if you're in a corporation. We talked about the small business deduction. So that's the 12.2% that we were talking about on the first 500,000. Another tax credit is a big one, is the SR&ED and investment tax credit. So this is a tax incentive to support businesses with their scientific research and development activities. There's strict criteria for what qualifies as SR&ED. We have a whole team at M&P that helps write the SR&ED and will assess if the SR&ED claim makes sense, because there needs to be developing a new process or improving an existing process, creating new materials, devices, and products, and enhancing them by resolving technological challenges. There's like basic or applied approach. It's a whole sector of tax, this SR&ED, but it's a way that if you're doing these activities, you can get basically funding for these activities in the form of credits. And a lot of times they're intertwined with the IRAP, and that supports the development and the commercialization of innovation and technologies. It's a non-repayable financial asset covering 80% of salaries and 50% of subcontractor costs. So it's amazing. I've seen it in action, and I've seen businesses thrive.
And we have a bunch of, tech company, manufacturing company does, they get so much money from the government. It's great. I know if you're profitable, it's gonna reduce your tax, but if you're not, it's money in the bank. And it can go up to 50 cents on a dollar of expense, which is a lot. It's like it's a lot. It's a lot on top of the other credit you can get. Imagine every dollar spent on research and development, you can get half of it to reinvest in your company, reinvest in your project. It's like amazing. I think it's one of the best credit out there.
And especially as a startup where everything's expensive and you're feeling everything. I've seen it. Like I've seen startups use this to push their business, push the innovation, and get a fighting competitive edge. It's amazing to see it. The other credits we don't really need to talk about. We just wanted to talk about the main ones, but these are also ones: Canadian film, foreign tax credit. Usually you get it if you're paying tax in a foreign jurisdiction. It's to prevent the double taxation. So you get a tax credit for the taxes you've already paid in a foreign jurisdiction. Donation tax credit, that's also applicable on a personal tax return. And then there's the apprentice training tax credit. This was really kind of already discussed this. And then the only thing we hadn't mentioned was the development of the e-business tax credit in Quebec. It's a tax incentive similar to SHRED for business who carry, but it's specific to businesses who carry information design and software publishing with a minimum of 6 employees. Again, something that we at M&P can help with.
And then for those, I'm not sure, if there's entrepreneur in Quebec on the line, but for everyone that gonna watch it after, there's a bunch of credit for e-business in Quebec and also innovation. So the government of Quebec are pushing for innovation, but they're coming with grant, they're coming with credit. There's a lot of program available. Even for IT software implementation, there's like grant for paying consulting like us to do diagnostic and to do the implementation as well. So there's a bunch of credit out there. So if you need anything, you know where to find us. I think we talked about it.
Yeah.
Talk about Arab. It's linked to SHRED, and make sure when you do SHRED to look at Arab as well.
So this is the fun
Another
part.
one.
So one of the things we want to talk about is salary versus dividends. We all know what a salary is. You work, you get a set pay. A salary, if say for example, if you make $500,000 of salary, then you're looking at a tax rate of 53.5%. Dividends, it could be, depending on the dividends, it could be 39 or it could be about 47%. So it's cheaper dividends. If you go on the next slide, I have a salary versus dividend. So salaries, you typically subject to payroll taxes. And the payroll taxes a business owner that you would pay would be CPP. Typically, business owners don't pay EI because when they try to apply for it, there are complications. So typically, it's CPP that you pay into. And now there's a second CPP. So payroll has become that much more expensive. It's also a deductible business expense. Dividends, this is paid from your after-tax profit. So there won't be a line on your income statement under the expenses section for dividends. There's no CPP contributions. And if we manage your income, you can be in a fairly low tax rate. We don't want your tax rate to be too low because you want to be able to you have, so we call it marginal tax rates. We want to kind of use up your lower tax rate. It's not beneficial for you to show zero income, especially if you have a growing business, because on death, it becomes very expensive. So what we want to do, say, best way to describe it is, say on debt, you're going to have $10 million. $10 million that you're going to have to bring into income. Say it's non-eligible dividend, so it's going to be about $47,000. What we would plan to do is bring it in slowly at lower tax rates over your lifetime. That's basically a simplified way of looking at it. If you pay a little bit of tax every year, as opposed to one big tax bill at death, then you have more to pass on to the next generation. It's just good planning, because part of what we're trying to do is help create wealth that can be passed on to the next generation, so that the future generation doesn't have to struggle the way that you did. And that's how communities grow, and that's how communities thrive. So what we're trying to do is teach you teach you the right way to do things, and the right way to accumulate wealth, the right way to pay tax, and the right way to pass on to the next generation, so that we can have a not a wealthy generation. So another thing we had talked about was income splitting. And I showed you the structure, and there was shareholder, and then there's a little square box, and that's supposed to a rectangle box, actually, that's supposed to represent your ownership of the company. So before 2017 actually was that magic year. You were able to what we call income split with everyone in your family once they were over 18. So what would be done is you would issue shares to your 18-year-old, 19-year-old, 20-year-old. And then what would happen is you'd pay dividends on those shares, and those dividends would be taxed in their hands at a lower rate than if you had taken all that money. I guess the best example is, say there's 5 of you in the family, say you're all 19. If, for example, let's use mom. If mom was the owner of the business and mom took $500,000, 53.5% would go to the government. So what we would do instead is split it 5 ways, and then you would benefit from what we call the lower marginal tax rate. So instead of having all that money go to the government, you share it among the family members, because you're paying their bills anyhow. It could be used to pay tuition. In some cases, once your kids go to university, they get tuition credits that completely wipe out the tax. There have been changes to the rules, so we cannot do that anymore. But it was a really, really, really good strategy. So what they've come out with is what we call TOSI, tax on split income. And so what they're saying is that 100,000 that was split 5 ways, because these members of the family didn't contribute to the business in any meaningful way, we're going to say that that income is subject to the highest possible tax rate. So now you've removed the benefit of income splitting. So what we say, if there's a wife or and you're working together, or a husband and you're working together in the business, because we know the wives and the husbands work together, like especially as a family, you can't do it on your own. So if they're helping out, just document it, have them come to the office, have them, speak to the accountant, have them speak to the delivery people, have them assist in payroll, whatever you can do to substantiate dividends out to them, and even salaries, because even salaries are subject to what we call a reasonability test. You cannot pay your husband or wife $100,000 to sit at home. They actually have to be working and being part of the business, or they could be the deduction would be denied to the company, and then that income would be taxed at a high rate on their personal tax return. So you're going to get hit with double tax. So these are some of the things we educate or clients on. So we kind of talked about the highest tax rate, the 53.5. Capital gains is 26.5. And then we talked about the eligible dividends and the non-eligible dividends. So these, I'm looking at Ontario because that's where I'm from. And most of my work is out of Ontario. We do other provinces, but I'll talk about Ontario because.
And that's again, it's for corporation.
Yeah.
Just
personal.
Personal. It's personal. Okay, sorry, personal. Sorry, it's for personal.
So these are your highest. So when you take the money out of the corp, then you're at these rates. These are the highest rates. So eligible dividend 39.3 at your highest rate. And then non-eligible is 47.7. So if you don't need the money, we would suggest taking less and reinvesting it into the business and keep your tax rate below the top rate. But if you do need the money, then again, you're still benefiting significantly. This is your top rate at 53.5 in Ontario versus your top rate for non-eligible dividends of 47. There's a bit of deferral. It's not significant, but it's better than nothing.
I'll go to the next slide.
So these are some, we talked about this. So as the operation grows, you don't want to have too much cash in your operating company. If you were to be sued, it becomes susceptible to debtors. So what we would do is move it up here, and then you move the cash to the holding company, and then you could invest it and it can grow safely. That's some of the asset protection that we were talking about. There's another structure where you could even put in a trust, and the trust gives you.
Put the trust.
All right. So the trust, this is a structure. There's other options of where we can put the trust, but basically what had happened. So what you would do is put your family members on the trust. So you put your husband, you put your wife, you put your kids, you put the grandmother. And for example, in 50 years, when your company is sold for 50 billion, that's a dream, right? That's what we're working towards, right? That's why we're forming a business, to make money so we could live comfortably, so we can teach the next generation how to manage money, how to keep money and safeguard generations to come. And this is why we're doing this. So what you could do is basically shelter most of the gain on the sale of those shares by having your family members use their exemption, their capital gains exemption, which sounds like a fancy way, but it's a very valuable deduction, and we use the trust to multiply it.
I'll give a real life example. Real life.
Go ahead.
Client of mine in the food and beverage industry, right? We have a structure like that. Sold the business for like 9 million-ish, 10 million. So he put him, his brother, wife, and kids in the trust. So basically in Canada, what's happening when you sell certain business, private entity, there's some criteria. You have a once in a lifetime deduction. So exemption for the first 1.2 million of gain, it's exempt, right? So by putting many people in the trust, every one of them gonna have the 1.2. So technically we put, I don't know, 6-7 person in the trust. Everyone got the exemption of 1.2. And at the end of the day, paid like on 9 million capital gain, pay like 100, 200K, nothing. You pay nothing just for a structure like that, right? It's key for you guys to have this type of information, and you're not putting a structure like that before a transaction. It has to be in place at least 2-3 years before you do the transaction. And as we have to check, we have to make the calculation. There's a bunch of criteria we have to make sure they are met. But it's good for you to know for your exit strategy, where you want to go, you want to grow, but at some point, maybe you want to pass the baton to the next generation. That's why you can do a transaction. You can do a transaction, what we call a freeze, whereby, you're going to freeze the value of your shares in preferred shares and put everything in a common shares. And then the future value will be to your kid, but your kid's going to have access to that deduction of 1.2 million. And every year, that threshold increase with, inflation and the way of life. So technically in 10, 20 years, maybe our kids going to have like, I don't know, 3-4 million exemption for the first 4 million, capital gain. It's magic. Like, imagine you work hard, you sell your business, and you're paying not that much tax, right? It's one of the key planning that we do for our clients that think of selling. Like, you need a trust. I think, Cylena, you mentioned a bit the asset protection part, right? So go back a bit to the sorry guys, I went too fast. Okay, so I went back a bit to the asset protection part. You can get sued, right? Left, right. So if you get sued, you want your asset to be protected, right? So in the operating company, let's say, I think, Cylena, you mentioned it, you have extra cash. You finish paying everybody. You pay your salary, you pay all your debt, all your AP, everyone got paid. You have 100K sitting in cash. If you get sued by your supplier in your operating corporation and you lose, that asset is in danger. Like, they can seize the asset and pay themselves, right? So by putting like that type of structures, we kind of move on the year-to-year basis, depending on the tax calculation. There's some tax calculation to be done, right? We call it safe income, but I won't get too much technical, but you need to do those calculations. And on the year-to-year basis, you're moving the money dividend free, because intercompany dividend are free. So you move it, exactly, you move it to the holding company, and then you invest, as Cylena put it. But let's say you got sued, right? You got sued as a shareholder. Unfortunately, the person that sued you on the personal side might have access to your old structures, right? Your old assets. So that's why sometimes we put those type of structure, because if I'm a beneficiary of a trust and I owe nothing, I have $0 in my bank account, nothing. But the trust owed like $1 billion corporation. I got sued. There's nothing. I owe nothing. The trust is a flow through. I'm not owing the trust. No, I'm not owing. I'm just a beneficiary. So the trust owns the opco that value $1 billion. I'm owing nothing. I don't have nothing in my bank account. However, I'm crazy protected. I'm very if someone sue me, there's nothing. They have access to nothing. That's the beauty of having having a trust. There's many purposes, but those are the type of tax planning that we can put in place. There's more than that, but for the time we have, I know I saw there's a couple of questions already, so we're gonna go deep into the question, and then if you have any type of question specifically regarding those type of structure that we put in front of you, we see it as a free consultation, and then there will be the phase program, and then we can deepen our relationship.
Yeah, we've simplified everything just to make it more understandable and more digestible. But these structures are here to reward your ingenuity by going into a business. It's to reward the risk you've taken. Many business owners we've seen, they leverage everything for this to grow their business. they're spending a lot of time away from family. So this is kind of the reward for doing that.
So go to the next slide.
So that basically concludes our presentation. This is kind of all the services we offer. We're not just an accounting firm. I'm sure you could tell we're not just an accounting firm. We do everything. We do bookkeeping, we do preparation of financial statements, but we also do tax planning. All those org charts that we showed you, that's part of tax planning. All the efficiencies we've talked about with the tax rates, that's part of tax planning. As your business grows and you want to add spouses or kids to a trust, that's where business evaluation and tax planning, they go in tandem because we have to value your business. As you sell to the States, there's cross-border implications. We do everything. We're a one-stop shop. That's what I call it. You don't have to go anywhere else.
And then you're right. You know, we didn't talk about MNP a lot, but you know, we serve a lot of entrepreneurs all across Canada, and we have like a good print on, you know, all the provinces, all type of services, all type of industry, construction, financial services, you know, manufacturing. We are here to serve entrepreneur tech. We very involved in the tech industry. And look, there's a program, there's the TD program. We're gonna take the time to help you guys. And I just want to say thanks for Face for arranging those type of masterclass. And we're gonna take the question. Hopefully there will be some engagement. I'm expecting like a lot of profound question, and we like that part. We keep the best for last.
Awesome. Thank you so much, Steve and Cylena, for that wonderful presentation. There was a lot of information, so I hope everyone here has gathered as much as they can. And now is the time to ask all the questions that you have. Please use the Q&A section. So I will start with just one question that we have in the chat, just so that we don't miss out on that one. Does the deferred income rule also apply to prepaid accounts? I have a laundromat where I want to preload client accounts. Is it only considered income the moment they use the funds for a wash or a dry cycle, or is it the income accounted at the time the funds were loaded into the account?
That's a good question. Basically, you don't want to prepay tax, right? If you receive money and there's no services rendered, it's not a revenue, right? It's as simple as that. Look, you have to match your performance obligation with payment, right? If you receive too much money, or you prepaid, or your client prepaid, it's kind of, you cannot record that right away as a revenue. They have to use it to start recording. There's other rules, right? Let's say you have a contract with your client, they pay you, and they have like 3 years to use the money, right? And they never used it. And in your contract, there's a specific clause that say, look, if they don't use it, you know, after 3 years, it's lost, right? So, but you won't book your revenue right away. You're gonna wait for the period, or you're gonna look at the whole history of clients and how much are using, how much are not using, and then you're gonna book the revenue. So, look, you have to just be careful and be cautious of those type of rules.
And just make sure you document, because if in any case a review by CRA, they want documentation, why this was done and the rationale behind it.
Okay, perfect. So we start with the Q&A questions. With the meals and entertainment examples, can you include working lunches / dinners, meetings with colleagues or contractors?
Yes, so that would be considered meals and entertainment. But if you have staff and you're having a holiday party and everyone's invited to this holiday party at your office or wherever you have your holiday party, then that's a separate, that's we consider it staff meals and entertainment. And the tax rate's different for that. So you'd have to separate the lunch where you have all your employees versus when you're doing one-on-one with a colleague or you're taking out a subcontract.
Okay. Next question. We are incorporated and 50-50 ownership. As a partnership, does that mean we fall under partnership? That's the question.
Not necessarily. I read the question.
Yeah.
And a partnership, it's a separate legal structure. So basically, you have to look at your incorporation paper, what is mentioned, the act, right? If it's gonna say, right? A partnership, usually you have what we call a partnership agreement, right? And there's specific, when you go incorporate as a partnership, there's a specific box to click to be a partnership. It's not because you're 50-50 that you deemed to be a partnership. No, a partnership is a separate legal structure. You can have like an incorporation, like a Inc., and be 50-50, 60-40, 70-30, and still it's not a partnership because legally you incorporate as like a share company, right? So hopefully it's answered the question. You have to look at the legal paper.
Okay. All right. Next question. As a new incorporation, we recently launched our marketing agency and we are hoping to secure our first contract by December 30th. I had a freelance contract less than 5K as a self-employed and provided my GST number. But if we don't hit the 3K threshold, what do I declare?
So if you collect HST, you have to remit the HST. That's the basic. Like if you collect it and you're under 30,000, you can't keep it. You got to remit it.
Okay. All right. Okay, was that for the SR and ED or IRAP when you mentioned 80% of the salaries of the cost of the research?
That was the IRAP. That was relating 80% was the IRAP.
IRAP, okay. Okay.
Can be up to.
All right. Jared, I think my apologies. I added my question in the main chat. Okay, I think that's the one we asked
That's
about the deferred income. All right, that was answered. All right. What are dividends? What do you mean by eligible and ineligible dividends?
Wow, that's a deep question. You want to take it? Okay.
Okay, let me
I'll
try.
take this one. Okay. So as a owner of a corporation, there's a couple of type of compensation that you can get, right? And as Cylena put it in the presentation, there's the salary. We know everyone knows the salary, right? You get reward, you work, you get your salary, your T4, thanks. A dividend, it's money after tax. So you do your company, you have revenue minus your expense, you pay the tax, everything is done. So you have what we call retained earning. So those are undistributed revenue to the owner. So if you can get compensated by taking out of that pool of money that you generated as a corporation, right? So that's a dividend, right? What we call eligible, non-eligible, it's two type of dividend, right? Two different rates. If you are a large corporation and you're mostly paying money, your taxable income is above, sorry, I'm being a bit technical, but I think trying to put it simpler. So if your taxable income is above 500K, and you're paying the higher rate, so the 26.5%, you are allowed to pay what we call uneligible dividend, and they gonna reward your shareholder by taxing that dividend at the lower rate, because in the corporation, remember, you pay a higher rate, right? So you pay higher rate in your corporation, allow you to pay a dividend that get taxed on the personal side on the lower rate. On the other side, if you pay the lower rate, so the 12% in Ontario or the 13.2% in Quebec, you cannot pay your shareholder like uneligible dividend. It's gonna be non-eligible, and the non-eligible dividend, it's just to compensate the fact that you pay the low rate on the corporation, so on the personal you're gonna pay the high rate, right? So bottom line, what the regulator, what the tax people want to do is they want everything to be equal all across the board, right? Dividends, salary, personal, corporation. It's not, they call it the integration. It's not always perfect, but that's the main goal here. I know it's a lot of information, but if you have a follow-up question, put another one in the Q&A, and then we're gonna go in much detail.
Okay, thank you, Steve. Cylena, do you want to add something, or you good?
No, that's
Okay.
good.
All right. Okay. Perfect. So this one, okay, I'll try to read it from what I understand. It says, should the OpCo be a shareholder of the HoldCo? Can the operating company transfer funds into the holding company without the OpCo being a shareholder?
You want to take this one?
I'll say it depends. Because if you have a trust, you can, and the corporation is a benefit, and the corporation, I'll say it depends. It depends. It's not so straightforward. Depending on the structure that you have, there's a possibility where it doesn't have to be directly owned, but it could, if it's owned through a trust, there's things that we can do. I don't know if I answered your question.
No, you answered the question. So technically, it's not, yes, we present you the simpler version, right? To protect your asset, move your money from the OpCo to the holding corporation. But as Cylena put it, there's others. If you remember the structure with the trust, one of the beneficiary can be a holding corporation, whereby you're gonna move the money from the OpCo to the trust, and then the trust gonna allocate that to the holding, and then the holding gonna invest, right? And I'm read the question just to make sure we address everything. Should the OpCo be a shareholder of the HoldCo? So the OpCo cannot be a shareholder of the HoldCo, and can the operating corporation transfer fund into the holding without the OpCo being a shareholder? That's yes. We can put a trust, or they can be sister company, right? Depending on what you're trying to do. Basically, to answer perfectly, we need to know the needs, what you're trying to accomplish. And then we can, the answer is more general, but
Yeah.